The Dow dropped significantly in one of the sharpest declines we've seen this year. Bond markets are showing movement and inflation remains a persistent concern. Was the Fed rate cut hawkish or dovish? Either way, the most recent action by the Fed has introduced new challenges for traders. In today's video, we'll break down Todd Gordon's expert insights on stocks, bonds, commodities, and the dollar, and most importantly, how traders can make sense of the Fed's action and plan for what's ahead.
If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly.
While the headlines have been dramatic, the key question remains, what actually has changed in the Fed's statement? Let's hear Todd's take.
Here's what changed in the Fed statement, which was nothing. Fed funds rate by 0.25% to 4.25% to 4.5%. And considering the extent and timing of additional adjustments, I mean, that was really the only thing that's changed in the statement. So really not much.
Even with minimal changes to the statement, the restrictive tone and limited rate cuts projected for 2025 are what traders are apparently focusing on. With the Fed's tone now clear, markets reacted sharply. Todd breaks down the key sector movements and where traders should focus their attention.
So we look at the market reaction. The 10-year yield went up to 4.25%. The market has been acting a little dicey. Being that tech and growth has led, we're seeing cyclical stocks, consumer discretionary, with the exception of Tesla and Amazon, which are more growth stocks, underperform a little bit. And there's inflation. We saw some of that. Some of the wage pressures earlier last week start to tick up. We're seeing the dollar be strong.
Beyond the immediate reactions, Todd highlights how inflation expectations and market pricing for future rate cuts are shaping the outlook.
The part that's hitting the market, Fed indicated probably lower twice in 2025, according to the dot plot. Right, so if we just take a look at updated here on the Fed Watch tool, that's going to come off now. So now it's interesting. We're only pricing in one more cut because current is 4.5 to 4.75, going down to 4.25 to 4.25. 4.25 to 4.25, which the market is now pricing in one more cut, and then that's it.
This projection of limited rate cuts has added to the volatility, with markets now adjusting to a more cautious Fed tone heading into 2025. The dollar has been another major player in these market moves, with implications for commodities like gold. Let's hear Todd's take.
Dollar yen is up 0.6%, but Aussie yen, which is a key, equity correlated yen cross, is down 0.5%, which is not a great look. Not a great look. Okay, so we're starting to get a little dollar strength that is not dollar yen led, that's carrying the rest of the yen carry trade higher. It seems to be more of a dollar rally. And this could become a problem. So here's the dollar index moving higher. Speaking to a client at Inside Edge, he's an institutional bond trader, very intelligent, smart guy. He's based in Canada. He's like, Todd, check out dollar Canada, the exchange rate. And I hadn't looked at it in a while. And if we just look at this, look at the weekly of dollar Canada. Actually, again, we got to go to the monthly. Look at the triple top ongoing here in dollar Canada. And what this means, if this chart goes up, dollar strengthening, Canadian dollar is weakening. Right? So when a market tries something 3 times, it usually, a third time, it really wants to get it. So when he encouraged me to look at that chart on the long term, I was like, oh, that's really interesting. So the dollar strength, based on what we're seeing here from the Fed, only one more rate cut, some inflationary concerns, this could be a problem.
Despite concerns about inflation and the Fed's hawkish tone, Todd reminds us of the tremendous opportunities ahead. He highlights AI and quantum computing as a transformative force driving long-term growth.
I do believe, bigger picture, we're in a secular bull market. I think this AI evolution, quantum computing, the cusp of what we're on gives us the ability to outgrow some of these concerns that we have with budget deficit.
Todd highlights that despite near-term challenges, technological advancements in AI and quantum computing could fuel long-term growth, allowing the economy to address structural issues like budget deficits. Todd also points out encouraging signs of economic resilience, particularly in the bond market and the overall strength of the U.S. economy.
We went up to 4.5. This is where we were, a month or two ago. We've backed off. We got down to sub 4% several months ago. That was too low for the strength of this economy. And the good thing is, if the 10-year yield keeps going up and the 2-year yield maintains, what does that do? That takes the yield curve further out of inversion, which that's the shape of a healthy economy.
The yield curve is moving out of inversion, a key sign of improving economic health. Todd points to this as an indicator of resilience in the U.S. economy, even as we navigate near-term challenges. While challenges remain, Todd's insights remind us that there are significant reasons for optimism. Technological innovation, economic resilience, and improving bond markets paint a balanced picture of the road ahead.